the market is saying the Fed's going to cut rates, right? Yet we're seeing inflation is very sticky, which to me shows a more stagflation environment, which is kind of how our hedge fund is set up. We've been saying this for 2 years, that we're going to have a stagflation environment for a number of years because the Fed is caught in a debt trap. The consumer, for the most part, is caught in a debt trap. Companies are in a debt spiral as well, especially there's a number of zombie companies. That said, there are a number of companies out there, again, Microsoft, some of the biggest companies in the world have strong balance sheets, have strong margins. They believe in AI as the next leg for valuation. So their stocks are very high. But, like you described, I mean, so when you look at the money markets, you look at short-term cash, it offers a really good blanket for a lot of people that have assets, that have rolled the market even and said, look, I had a really good year, a number of good years. This could be a time to diversify my assets, keep it in the front of the curve as well, and yet maybe perhaps have some specific exposure to some equities as well as bonds. So I just think it's too early in the year. But as you described, I can't see that the Fed is going to be aggressively cutting rates unless the global economy starts to go off the rails, in the U.S. especially. So that would be more of a recessionary risk and more a hard landing, which is a real possibility and what Livermore thinks is really possible still. And if that happens, then you got to ask yourself, what does that mean for earnings, right? What does that mean for revenues? Microsoft's a great company, but
sure.
they're I can tell you one thing: their earnings are going to go down and their multiple is going to contract. Same thing with Amazon and the like. So you can't have it both ways, is what I'm saying.